Hello, chart watchers and Decision Point faithful. Welcome to this Monday, December 7th, 2020 Decision Point show. My name is Erin Swenlin, and I'm here with my father, Carl Swenlin. We are from DecisionPoint.com, and it's our job on Monday afternoons to prepare you for the week ahead, tell you what is going on in the markets, what we're looking for, as and including a diamond of the week at the end of the show, which is my pick from last week's diamonds that I think looks good and is still likely to continue higher. So let's start off. We're going to start with our SPY overview. Carl's going to talk about that, as well as how the market is very overvalued. We're going to look at sentiment charts. I was supposed to do that last week, and I got totally wrapped up in those monthly charts. So I'm going to show you those sentiment charts today for sure. Want to talk a little bit about silver and gold. I am also going to show the natural gas chart. I think UNG is looking interesting, but we have to take a peek under the hood there. Diamond of the week, as I hinted, I will be presenting that at the end of the program. All right, before we get started, Dad, how's everything going for you this week?
Very good.
Excellent. Well, I'm going to let you start right off with the overview of the SPY, and you can talk to us a little bit more about the overvalue in the market right now.
Okay. Well, the market we have a short-term rising wedge here, which should resolve downward. It usually does. Those kind of formations. We had a little bit of a breakout on Friday, but we're still back inside that wedge right now. The volume was contracted somewhat today. It's not terribly low though, and the VIX, it dropped back and touched the 20-day moving average. We're talking about, I'm going to talk about overvaluation today. And John Husband of Husband Funds, his latest commentary, beginning of this month, he's saying it's the most overvalued market in history. Now, he uses what he calls margin adjusted PE. I honestly don't know what it is, but it's one of the things that, tries to refine it. How we look at it, but I'm just going to use the standard traditional PE range. Here we show, here's PE ratio. This is back to 1920s, and we got overvalued at 20 PE here, and then undervalued at a 10 PE here. Well, we're certainly out of that range, and I drew this pink line across the top of the PE where it was just ahead of the 2000 top. Now you notice there are two peaks higher than that, and these are outliers. I think what they have to do with is with the earnings actually crashing these 2 points, so that threw the PE up in the air pretty quickly, and I don't think we should. This is not what you would call a standard, well, as I say, it's an outlier.
Yes.
It doesn't count to me. But you'll notice that, so that would put the 2000 PE level at the highest, except for right now, we're a little bit above that right now. Even back in the 1929 top, we were just at the top of the normal range, and that was a PE of 20. So we're really, let's see, right now the PE is 37. And so that, it's very, very overvalued. Overbought and oversold, that's something that it swings back and forth in a regular basis, and certainly nothing historical about what the levels we have now, but we are overbought. Let me just take a quick look at one of the charts we use to measure that. This is your stocks above their 20 EMA, 50 EMA, and 200 EMA. And you can see they're at near the top of their normal range here. And neither one of these things will prevent the market from going higher, but it's not a good situation for us to be in. I mean, again, just remember, investors' willingness to speculate can turn on a dime, just like it did here. The 35% decline, that could have gone on further. But just remember, I hear a lot of bullish talk on the TV, and it's good for today. We don't know what it's going to do tomorrow. And as I said, overbought and overvalued is definitely not a comfortable place to be.
Yeah, you don't want them to go hand in hand.
No.
Right. And we have been pointing out those very overbought readings, on this particular chart. And, one of the things that I learned from you is that, and you can see it on this chart, is that when we have a strong bullish bias or a really strong bull market configuration, if you will, you will tend to see those overbought conditions stick around for a while. So it's not necessarily the end of the world, but we've had these overbought conditions now for quite a while on these indicators.
Right. And you notice here, we've got negative divergences in two places, and market keeps going higher, which makes it a negative divergence. But here, it persisted over about 3 months. And finally, we did get a pullback which was warned by the negative divergence, but it was warning and warning all the way the market was going up. So it tells you things are out of balance. You can't exactly predict the future, but it's a warning to be extra careful.
Absolutely. And these are all the things we've been talking about in the decision point alert. Before we get started too far, I realized I hadn't gone over our signal tables. And so I'm going to do that really quickly. Hang on here so I can have it ready when I share the screen. All righty. So yeah, one of the things I did want to share after talking about what we were going to go over is that right now at DecisionPoint.com, we are running a holiday special. You can save 15% on any of your subscriptions. Right here, I've brought forth my Decision Point bundle just so you can see how great these deals are. Instead of $80 a month, you can go $68 a month on our monthly plan. And of course, if you go to an annual plan, you get an additional 2 months on top of that because you're only paying $680 for the whole year. So welcome you to go to our website, decisionpoint.com, and click on our subscribe or products tab, and you will be able to find what we offer and take advantage of this. Just use the coupon code holiday 2020. So yeah, and really no changes on the scoreboard. So it's not, really an exciting picture to look at. Everything is still very bullish. You've got all of the trends and, we're trending upward in all 3 time frames. The only one that is an anomaly is this Dow Jones long-term PMO sell signal. And it just barely missed the buy signal last month. We'll be checking at the end of the month to see if this signal changes at the end of December. And then, of course, the sector scoreboard, it's the same picture, everything is green. We're on buy signals in the intermediate and long term for all of the sectors. With the exception of XLE, we have a sell signal in the long-term trend model. That means that we currently have the 50-day EMA below the 200-day EMA. But you know that energy has been making a really great comeback. So that should go away, but it was just so beat down. It had moved so far to the downside that the 50-day EMA had just moved so far below the 200. That's why we're really taking time here before we're going to see a switch here. And, honestly, we could end up seeing XLE turn before we even get that long-term buy signal. All right, so now let's get back to the charts. All righty. So I wanted to go over these sentiment charts, and Dad, feel free to pop in here. So the first one I'm going to look at is the 10-day moving average of the put-call ratio. So this is what's going on right now in the S&P 100. You've got your line chart. And then what we look at is the put-call ratio and then take the 10-day moving average, just like the name of the chart says. And you can see that typically I've marked these areas. Let's see here. Yeah, I've marked some lows so that you can see when we want to see this turn. But you can see that when we're at market bottoms, typically this is oversold into the downside. And typically before these big declines, you are in overbought territory on this 10-day moving average of the put-call ratio. And right now, we are sitting at a reading that is every bit as high. I have to go back and check. It might be higher than what we had at the top here for September. So again, here are all these warning signs we're seeing. We're seeing sentiment is extraordinarily bullish, and that usually is time for that reversal. And we have those negative divergences. There's so many things that are flashing warning signs. But at the same time, we have a very strong bullish bias, and none of us want to, lose out on what rally there might be left to eke out here. This is the AAII poll. This is the American Association of Individual Investors. And this is a finger in the wind poll, as I like to call it. You can go to their website, just say, I'm bullish, I'm bearish. That's pretty much it. And you can see that the bearishness has been getting further and further, we're getting less and less bears and more bulls. And we're now at the top of that range. And then look also here at the ratio, the bull bear ratio for AAII. We're looking at readings above 2. And again, if you look at what happens at some of these major market tops, that's when you're going to see that when you get these readings, this ratio above 2. And we've had quite a few here. We've had 2 readings. That's just an anomaly. It's a shadow, if you will. So it's the same. But you can see that we've had a reading over 2 the week before, and last week we ended up with a reading of over 2 on that bull bear ratio. Certainly not a place you want to be seeing. And again, so we're seeing sentiment extraordinarily bullish. Now, this is the National Association of Active Investment Managers. And what we do is we look at how exposed they are to the market. And right now, as you can see, high exposure here in that thumbnail. And again, marking some of the significant tops in the market, typically you're going to see right before those really high exposure. You can see over here, really high exposure. That's because the managers are bullish. They're exposing themselves more to the market because they are comfortable doing so. But now we're seeing a very high exposure index reading. All right, I'm going to skip Wall Street sentiment. Oh, didn't mean to go to that one. We'll talk about that later. So this is the Rydex analysis that we do. I've explained this a lot as far as why we call it Rydex. These are funds now managed by Guggenheim, but it's a group of funds that Rydex did. And what we did is we were able to split them up to the bull and sector funds and look at the assets in each of those, because Guggenheim reports that. We can look at the assets in money markets, and we can look at the assets in their bear index funds. And it's nice because once you know these, you can compare them by making a ratio, which is what we did with the Rydex assets ratio. So you have your bear and money market assets on the top, your numerator, and the bull assets are on the bottom. So this ratio will get smaller and smaller and smaller the higher and higher the bull assets are in relationship to the bear assets and money market assets. So we have this inverted because low readings obviously mean people are very, very bullish. And that's sentiment that you don't want to see is when you're at the top here, that's overbought. And of course, when you're low and the number is higher, that means you have a higher amount of bear assets than you do up here. Okay, so just looking at this, I mean, that Rydex ratio is really concerning here. We're looking at a reading now data. I mean, I haven't looked at the history here of how overbought we've seen this Rydex ratio, but this is extraordinarily overbought.
Yes, it is.
So here we've again marked some cardinal highs, and you can see typically when that Rydex ratio does start to get overbought, that is when trouble arrives. I mean, it's pretty much right on, I mean, that it's a pretty good tool to see whether we are, as far as sentiment, bullish or bearish. And like I said, that other one was a finger in the wind. This is, we're really marking what assets or what the money is doing, money where your mouth is. So I find this one to be especially helpful for sentiment. So I would say if you look at all of the sentiment charts now and put it all together, I think it's pretty clear. Very overbought because we have highly bullish market participants right now. I'm going to look at one more sentiment indicator. We briefly talked about the VIX, but I did want to look at that chart a little more closely. Here, so I can see the VIX more closely. All right, there we go. So I talk about the VIX a lot. We do invert our scale because overbought's on the top and oversold is on the bottom. So we've had, we had a lot of volatility, expanded these Bollinger Bands by quite a bit. And then, the VIX just stayed above its moving average. And typically when that happens, there's internal strength in the market. Market participants are bullish. What concerns me is this reading that we got today where we are still above that moving average, but we've actually come down and touched it, which we haven't done since the beginning of November. And we get below that moving average and things can get a little bit more dicey, if you will. And now that we're seeing less volatility as we've traveled over here, those Bollinger Bands started to squeeze tighter. And when we get those penetrations of the Bollinger Band on the upside or the downside, that will usually mark important tops, or in this case, important bottoms. So that's why we keep such a close eye on it. And seeing the VIX getting ready to go below that moving average on the inverted scale, as far as sentiment goes, tells you that now we're starting to, a little bit of fear is starting to maybe creep in here. And if we start to see that continue with higher readings on the VIX, we'll get that penetration, and that would be a pretty, that would be a good sign if we end up in a decline, if we can get that move down here and penetrate that lower band. But the fact that it's moving downward tells me that we're starting to see a little bit more internal weakness.
The reason that we use a log scale is also so we can see the movements at the lower part of the range. That's the low part by the scale. And you wouldn't be able to see very much. And to me, it's worthwhile. I mean,
Yeah.
you have to put a gun to my head to make me use a log scale on price, but this is the perfect case where you, in order to get to see the lower readings at all, you've got to use a log scale.
Absolutely. And we talk about that a lot at Decision Point. A lot of people ask me why I don't use the log charts very often. And, both of us have discussed it, that on a log chart, your trend lines, support and resistance are pretty much the same, but your trend lines they're kind of nonsensical on a log chart. You'll see them, but they're not necessarily meaningful.
And you really don't get a sense of the emotions in the market on the, as you get higher on a log scale, the price becomes compressed. You don't really see You're going to put that on log scale?
Yeah, I can do that.
Now, I don't think it'll be, it's not as good as when you know, long-term start a chart.
Yeah, but you get a lot of this, you can't see a lot of what's going on.
No,
It works back here because we have that big volatility in that move, but.
Make it a monthly chart.
Ah, that's a good idea. Do we have one? We have one in here. And now we have,
Lose a lot of
the log.
Yeah.
Yeah. So you don't really see the like you were saying, that emotional, so I'll just slide it over here so you can see. You can see how we really can see those big dips on the non-log scale. And when you come over here, it just doesn't track the same. All right. Excellent little lesson to go on there. All right. So I was going to talk about silver and gold, I think, next. And definitely would love your input on the gold chart, and let me know what you're thinking too.
Yeah, well, you know, you remember we were talking about it in the weekly wrap that, you know, it wasn't looking so great. It had come up to that line that, of resistance, which was support that was broken. So it was not looking too swell. I got a feeling that it might have wanted to turn back down. But
right.
Today it took off. Great.
Yeah, we really got the nice pop. The PMO had already turned up, and we have been noting those high discounts on the physical gold trust. And typically that's a good thing for gold. It's not for sure, but typically when you get those high discounts, it's a good time for gold. I thought really what was interesting, and I talked about this morning in your Daily 5, was the fact that the correlation with the dollar. We're starting to finally see, you know, with the dollar having difficulties and not looking good right now. I could throw that chart up, but we don't have a whole lot of time. But we're starting to see them uncouple a little bit more. And when they get into that 20.25, that area, they're pretty much reacting on their own. They're really not tied together at all. So they're decoupling as they come down closer to that zero. Just
notice the PMO crossover.
Yes, and that's today.
Yeah.
I think. Yeah. Silver was the other one I wanted to look at really briefly here. And I'm using SLV. All right. So silver, you know, has been acting differently than gold to some degree, and it's now in this trading range. And I think it's looking really interesting. You know, we had the PMO turn, the RSI has now just gotten positive, and you can see today we had that pop, you know, gold popped higher and silver did as well. And in both cases, it got priced over that 50-day EMA, which is what you want to see to get some continuation there. So I'm looking for a move at least to test this overhead resistance around 24. But just given how nice the PMO looks and the RSI not being overbought, I think there's a pretty good chance that we'll see a breakout here. Unfortunately, the moving averages aren't telling us much because we've been in a sideways move. The PMO not telling us that much because it has been very flat, but we are now getting that buy signal. I'll feel a lot better, I think, when it gets above the zero line though. All right, so that was silver and gold. Now I'm gonna look quickly at UNG, and I definitely would like your opinion on this because we didn't talk about this before the show. And I know you watch UNG like I do, very often. Right. And I've been watching it because, you know, obviously the indicators are looking pretty ugly, especially the PMO. RSI is oversold. So, you know, if it turns back up, that could be a good thing. But we're looking at these all-time lows now on UNG. So I am starting to get some chatter amongst my subscribers and email asking me, so is this the time?
Could you take the volume out of there so we can get a better look?
Absolutely. Everybody can now see. I'm going to make the opacity very low, so that way we can see through.
Okay, that helps.
Yes.
But you can see there, really, it dropped below the previous low, so that's not a good thing.
No, and the momentum is still really, really ugly. But this is a chart that I know both of us for sure are going to be watching very closely because obviously there's a lot of money to be made if it can turn itself back around just to get up to where we had it back in August.
It's
So
maybe not that far from that happening, really, because it's, yeah, the PMO is really getting very oversold.
absolutely. And I haven't looked at it on the weekly chart, but I'm going to look at it very quickly here too. And like I said, we're looking at these all-time lows. So I know it's very tempting, but you can see the weekly chart looks pretty ugly. You know, just because it's the bottom of the chart doesn't mean it's support. So you just have to remember that. It's looking at it, it's like, oh, it's at the bottom. It's going to start up again. No, that's what you could have thought all the way down here. So just always be aware of that. All right, time to close it out. Here is the diamond of the week. And I only have a second or two. So I'm looking at CGen. It is a biotech. It's now got a positive RSI, positive PMO. It's starting, it's been rallying. It hasn't done much. It's pausing after that rally. I'm looking for a breakout to close that gap and move higher. So I talked about that gap. That is really the overhead resistance that I'm watching very closely. The reason this one came up on my scans, we had the PMO turning up and I had the RSI moving positive. And you know, volume, I don't have that in my scan, but one of the things that I do want to look at when the chart comes up on my scan is to see what's happening with the OBB. And currently, you do have these rising bottoms as we're moving here. The one thing I'm going to be watching very closely is if we can get volume to push the OBV higher than this previous top when price reaches that previous top. If we see the OBV push well past this OBV top that matches that price top, yet price hasn't really made the move to even challenge that top, that's a sign that there could be a little bit of a problem in that price is supposed to follow volume. And so when it's not, that's what we call a reverse divergence. So I'll be watching this because right now it's very close to that previous top, the OBV is, but hopefully we will get a little bit of volume in here that looks like the momentum's still going. You know, at this point, I still think that you could make an entry here. I like to do it when I get that PMO just turning, but I presented this on Thursday of last week for my Diamond subscribers. So you're coming in just a tiny bit late here. What I wanted to show though, since we're on it, is here's the SGen, the daily charts on the left, and then I have the 5-minute candlestick, because this is, if I find something I want to get in, this is the chart I look at to time my entries and my exits. And, you know, when I looked at this earlier today, there was no entry. The PMO was moving lower, no entry, no entry. RSI is getting overbought. PMO is getting overbought or oversold. So this is what I'm looking for, right? So we got the turn. And then right about here, that's where you got the buy signal. And if you wanted to wait till the RSI had moved positive, your entry wouldn't have arrived until the end of the day. For me, I would have seen that turn. I would have gotten that PMO buy signal. I would have seen the RSI moving higher. I didn't know it wouldn't make it above there. But you can see that the buy point at that point would have been right about here, which was near the open. It's now near the open. So what I've told people that I do is, okay, maybe the entry isn't there right this moment, but I look at where it was previously. And if the price is right about there, then you're good to go. All right, that's all I have for our Decision Point Diamond of the Week, and happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.